So BDC is set up basically years ago. The government wanted more lending in small businesses.
Yep.
And to do so, they incented businesses to create structures where all of your earnings had to be distributed to shareholders. So essentially, nearly 100% of our earnings on an annual basis that we make go out in the form of a dividend.
Okay.
But to do so, you have to make investments just in companies. It can't be investing in financial instruments. You can't be investing out of the United States. It was meant as a U.S. policy to create more lending in the lower middle market space.
So you get a tax advantage for the structure.
The
rules are you have to invest it in operating businesses in a certain size segment.
That's exactly right.
Okay. All right. So did you have expertise in lending to middle market businesses that you brought to the table to make that conversion?
So, yeah. So my previous to Capital Southwest, I had, my background started years ago, unfortunately.
You look pretty young, but you know.
I feel pretty young, but I started in public accounting years ago, but quickly ventured into financial companies and several different sorts of financial companies, built up a background. But I kind of happened to across a company called American Capital, which was in a similar place in 2000. Had just gone public, had raised $150 million, had no infrastructure. I was the sixth employee, and we grew that to nearly $15 billion in assets and 1,500 employees. So
lending to middle market businesses?
Lending to middle market businesses. We started doing exactly what this company does, was lending to small businesses. That company sort of got off track a bit in terms of it decided to go bigger and bigger and bigger. So they eventually, the average size in the, by 2012 was probably around $500 million. Versus our companies that are, enterprise value is probably more like, some between $50 and $150 million.
Right.
So the answer is yes. So I've seen quite a bit on the investing side, but, my strength has always been on the strategic side, on the capitalization side, kind of strategic direction. So coming here, we had to build a deal team out. I mean, we started off with a few people that knew maybe, 10 sponsors. And so we were getting, and you know how this works. So you're seeing some deals, usually not their best deals, and you'd lose, and then maybe you win and you did a deal that was a little hairier than you wanted.
Sorry, I won.
Yeah, exactly. But eventually, we've grown that 10 to, we've now done a deal with, in the last 10 years, we've done deals with 150 different sponsors, and none of them more than 4 deals. So not really, no concentration. We've got a deal team of 17 people and another back office of another 17.
Office here in Dallas.
All Dallas.
And when you say deal, are you talking about like a loan?
Yeah, so these are all going to be loans. So typically these are founder-owned businesses that are going to seek out their first institutional capital. So say it's a 65-year-old man. He's like, hey, I've done this. I'm ready to do something else. And generally in those situations, they're selling to private equity. And maybe they're rolling over, 25% of the business. They're going to stay involved for a few years. Other instances, it's a family, whereas the younger, the siblings are ready to take over the business, and dad or mom is ready to kind of ride off into the sunset. Change of control there, where they may roll over 40% of the business. So the notion there is they're going to ring the bell once, right, with the initial sale, but then they're going to stay with the business to be able to create more wealth on the second time around.
So is it like an acquisition loan? Is that what you're doing?
So we're the debt in a leverage buyout. And so typically our typical deals are between 3 and 15 million of EBITDA. So it's kind of interesting. This is satisfying. The average deal size at origination is about 5 or 6 million of EBITDA, and usually, so leverage is usually 3 to 4 times. So we're giving them $15 to $20 million of debt, and then we'll usually provide some level of an equity co-invest. So that might be somewhere, $1 million to $2 million alongside the sponsor. But our average EBITDA of the portfolio companies that we have, and we have about 130, is 18 or $19 million. So that's all either organic growth or M&A. A lot of these companies are kind of buy and build. We were talking earlier, sort of some of the doctors' practices that are, you're seeing a roll-up strategy. We see a lot of those. In many instances, these are founders or business owners that they're either wanting to move on or they want to bring this to the next level, and they're all out of ideas. They're professionalized in the way they have audits, right? They've got a controller, they've got a CFO. They're clean companies. They've got their cash flow history. But they don't have the ability to take it to that next level. And so that's where the private equity comes in, they think they can bring it, to more success.
Like right now, it feels like rumor mills. And some levels, there's plenty of money out there, but on other levels, money's drying up. What's the reality?
You know what? It depends on where you live, I think, in the middle market. In the lower middle market, the deals are plentiful. I mean, and it's always been a drumbeat of founders wanting to sell. I think the M&A market over the last 2 years for large upper middle market transactions has slowed down. And that's a reason why in our lower middle market, we're typically, it's not nearly as competitive and the pricing is usually wider for these loans, for these instruments. They tightened up because we're seeing with the lack of transactions on the upper and middle market, you're seeing them kind of venture down. We've also seen banks. Banks are definitely risk on right now, which is not honestly, that's very inconsistent. And they're actually trying to win deals literally to 3.5 turns. These are, cash-based loans. These aren't asset-based. We're used to competing against banks when they're doing a turn and a half, really almost against the receivables. And then you see a mezzanine underneath them. Our company provides what they call a unitranche loan, which is both the senior and mezz together. And, a big advantage that we have versus other lenders is we're publicly traded. So we have very patient capital. We don't have a 3, 5, 7-year time horizon where we're like, we need our money back. We're not pounding the table. So to answer your question back, it's like there's plenty of M&A going on, and it's improving. Since April, I would say, since Liberation Day, things were starting to peak up, and then Liberation came, and everything froze for a period of time. Probably I would call it 3 to 4 weeks. And then I think people understand what the state of play is right now. The other thing that's causing concern is just interest rate risk. But as soon as that comes into focus, the thing about every market, but specifically our market, is we just want to know what state of play is, where are rates going to be, what the tariffs are going to look like. Our companies need to have that kind of direction to be able to move forward in M&A. So that's one of the things that kind of stymied growth, was the lack of really understanding of this administration has created uncertainty. Uncertainty is not good in the M&A markets. People just can't make decisions. You see that on the capital expenditure side, even for the largest companies in this country.
It feels like that's been a theme lately of the uncertainty when the administration is the way it is, the uncertainty it brings, whether it be in energy or in finance. But in taxes, we talked to a gentleman earlier who he loved it. He loved it,
Well, his services are needed more in uncertainty because things are changing, and he spends a lot of money and resources to figure out what those changes are.
Well, interesting. I don't know if you're seeing this in your business, but we're seeing so many accounting and finance businesses, but particularly accounting services.
Right.
You don't think it's not the Deloitte and Touches of the world. Obviously, these are the small providers. They're multiples that used to be 8 to 10. Yeah. Right now, if you want to buy an accounting services business, it's 15 to 20.
Yeah.
And that has a lot to do with the fact, exactly what you said. They're giving tax services, and that's ever changing. What's interesting now is what's happening after the the big beautiful bill. Healthcare has become another area that people don't know what to expect, especially where Medicaid comes into. So these tax experts, these healthcare services experts, they're in demand right now more than ever.
So I'm curious how you define the term middle market, lower middle market, upper middle market means different things to different people. So I think of the middle market as sort of being $10 to $100 million of enterprise value. Does that rhyme with your definition, or you've got a little different twist on it?
Yeah, I think for the lower little market, I agree with that. Yeah, okay. So it's right about there, maybe a little larger, but that's about right.